Welcome to the Explainer. Okay, let's dive right into this valuation gauntlet, where we put HP Inc. on the stand, judging its stock against the greatest investing minds and the toughest financial models in history. I'm stepping into the role of your expert investment analyst today, and we are going to tear apart HP's financials to see if it's a hidden gem or if it's actually a value trap.
To do this right, we have a strict roadmap today. We'll snapshot the company, run it through the Buffett, Lynch, and Graham lenses, do the raw math with a discounted cash flow and multiples analysis, and then finally synthesize a definitive verdict.
All right, Section 1. HPQ Company Snapshot. Current standing in Q2 2026 earnings.
Let's meet our contender. HP Inc. is a global leader in personal systems and print, and right now they are trading at a really interesting inflection point. The stock currently sits at $25.49 a share, giving them a $19.07 billion market cap. They recently beat Q2 2026 earnings by 20%, but, the street remains pretty skeptical.
And there is just a fascinating tension in HP's baseline numbers right now. On one hand, you've got solid net earnings, $792 million in the second quarter of 2026 alone, and an incredibly attractive dividend yield of 5.65%. Plus, there's a strong forward catalyst, right? AI PC mix upgrades are expected to lift their average selling prices. Yet, despite all this good news, Wall Street's mean target sits bearishly at $19.68, which implies a 23% decline. So who's right here? The bears or the fundamentals? Let's apply our first framework.
Section 2. The Warren Buffett Lens. Moats, Management, and Margins. Let's see how the Oracle of Omaha would view this.
Buffett loves predictable companies, with strong moats, honest management, and high returns on capital. But when we run HP through his pass-fail checklist, it's a bit of a stark contrast. Economic moat? Well, it's mixed. They have a fantastic moat in that high-margin print business, but PCs? That's a tough, commodity-driven space. Earnings consistency gets a clear pass, though. EPS grew over 16% year-over-year in Q2. Debt is totally manageable, with net debt to EBITDA at a healthy 1.65 times. And Buffett absolutely loves owner earnings, basically free cash flow. HP generated a massive $1.47 billion in free cash flow in Q2 alone. But return on equity? That's where things get wild. Buffett insists on high ROE, but HP has a negative book value per share of negative 16 cents. Why? Because management has been aggressively buying back stock, literally wiping out the accounting equity on the balance sheet. So traditional ROE is totally broken here.
Because that ROE metric is essentially broken for HP, we have to look at an alternative that Buffett respects just as much, and that's return on invested capital. For Q2 2026, HP's ROIC sits at a massive 35.48%. That is a number Buffett would absolutely love. Factoring in those massive owner earnings and this high ROIC, if Buffett applies his standard 20 to 30% margin of safety, HP looks very tempting at its current price.
Section 3. The Peter Lynch Lens. Growth categories and the PEG ratio. Now we're moving on to Peter Lynch, the legendary Magellan fund manager. He categorizes companies by their growth story to find hidden value and relies heavily on the PEG ratio. So the big question, would Peter Lynch actually buy HPQ at $25.49? The crucial point for him is whether the stock price accurately reflects its specific category and growth rate. Is it a fast grower, a cyclical, a turnaround, or a stalwart?
Well, based on our data, Lynch would definitely classify HP as a slow grower or a mature stalwart. Projections show a mere 1.4% revenue compound annual growth rate through 2030. Now let's do the math on Lynch's favorite metric, the PEG ratio. That's simply the price-to-earnings ratio divided by the growth rate. HP's trailing PE is a seemingly cheat, 7.47. But when you divide 7.47 by that tiny 1.4% growth rate, you get a PEG ratio of 5.33. Anything over 1.0 is considered expensive in Lynch's book. So despite the strong balance sheet and cash generation, that sky-high PEG ratio makes HP a likely hold or even a sell for Peter Lynch.
Section 4. The Benjamin Graham Lens. The Defensive Investor Gauntlet.
This is where it gets tough. Benjamin Graham, the father of value investing himself, has an unforgiving defensive investor checklist. Running HPQ through it, the company passes on adequate size, consistent earnings, and its fantastic dividend record. It even passes the moderate PE test, since 7.47 is well below Graham's threshold of 15. But it utterly fails Graham's liquidity and book value requirements. Graham wants a current ratio over 2.0.
HP is sitting at just 0.79, meaning its short-term liabilities actually exceed its short-term assets. And more fatally, Graham demands a price-to-book ratio under 1.5. As we just talked about, HP's book value is negative.
And that negative book value, it's the final nail in the coffin for Graham's approach. His famous intrinsic value formula is the square root of 22.5 times earnings per share times book value per share. Because HPQ's book value per share is negative 16 cents, multiplying it out gives us a negative number under a square root. It is literally mathematically impossible to calculate. Without a positive book value, Benjamin Graham would not touch this stock. It is a hard fail.
Section 5. DCF and multiples, the raw valuation math.
All right, let's strip away the guru philosophies for a minute and just look at the raw, quantitative math using cash flows and peer comparisons. If you're new to this, building a discounted cash flow or DCF model basically takes 3 steps. First, we forecast future cash flows. Second, we calculate a terminal value for what the company is worth at the end of that forecast. And third, we discount all that future money back to today's dollars using a discount rate, which is known as the weighted average cost of capital, or WACC.
So here are the actual inputs we extracted. We have a solid year-to-date free cash flow base of $1.309 billion. We apply that 1.4% growth forecast. Since the exact WACC isn't in our sources, we're assuming a standard industry average rate of 8.5% and a very conservative 1% terminal growth rate. When we run those numbers, the model generates a fair value of approximately $35 per share. With the stock currently around $25.50, that implies nearly a 35% upside. Now, if we apply a sensitivity table to stress test this, say raising the WACC to 9.5% or dropping terminal growth down to 0%, that fair value range compresses to between $28 and $32. Still, that leaves a very comfortable margin of safety for cash flow-focused investors.
But what if we look at a different model, like comparable multiples? Here we're comparing HP against a direct peer, Lenovo. HP trades at a slight premium to Lenovo on an EV to EBITDA basis, 7.15 times versus 6.73 times. And honestly, this premium makes sense. HP has incredibly strong, sticky margins in its print business. However, on a forward price-to-earnings basis, HP trades at a massive discount, 9.36 times compared to Lenovo's 13.68 times. So depending on which multiple you prioritize, HP is either fairly valued or highly undervalued compared to its peers.
And finally, Section 6. Synthesis and final recommendation. The ultimate verdict. Okay, we've run the gauntlet. We have qualitative tests, multiple models, and raw math. So when we bring all these intrinsic values together for our master synthesis, it reveals a deeply fractured consensus. Benjamin Graham and Wall Street analysts effectively say sell. Graham just can't get past that negative book value, and Wall Street is stuck on a $19.68 price target. Meanwhile, Peter Lynch and the comparable multiples approach suggest a hold. That PEG ratio is just too high to warrant excitement. But Warren Buffett's framework and the raw DCF math scream buy, pointing to massive owner earnings and a $35 intrinsic value.
To make our final call, we've got to weigh the strengths against the risks. The strengths are absolutely undeniable. This company is a cash printing machine. It generated $1.47 billion in free cash flow in one quarter, boasts a 35% return on invested capital, and pays a massive 5.65% dividend that is easily covered by cash. But the risks? Negative equity on the balance sheet, incredibly sluggish 1.4% growth, and heavy Wall Street pessimism. Ultimately, the final verdict rests on your own investing philosophy. If you prioritize cash flow and income, this is a strong buy at current levels. But if you're a strict asset-based fundamentalist, it's an easy pass.
Which really leaves us with this final thought to ponder. When free cash flow is this consistently strong, are traditional metrics like book value actually obsolete in the modern era of aggressive stock buybacks? Is Ben Graham's formula fundamentally broken for a stock like this? Or is Wall Street just completely missing the big picture? Let that sink in. Thanks for joining me on this explainer, and keep questioning the numbers.